Welcome to the Topic 6 workshop. So today we're going to be doing is estimating the cost of capital, and again we're going to be using H&M as our example. Now in front of you, you see the worksheet that we're going to be using for today, which is the one that you can download from iLearn. And what you'll see is the structure is that we have a number of sections that we need to kind of fill in to estimate our cost of capital. So on the top left-hand corner, we have the capital structure, which tells you how much debt versus how much equity you hold so that you know what percentages are. You also have a cost of debt section where you're supposed to fill in the cost of debt for the company, the marginal tax rate, which will give you the after-tax cost of debt. We then have a section to estimate the cost of equity, which is based on the CAPM formula, which we've covered in class. And this needs to have the risk-free rate, the beta, the market risk premium, any other premium such as size or country risk premium, and this will all give you a cost of equity. We then finally can estimate the cost of capital once we have all of this information. Now, to get to this information, we need to get some other pieces of other data. So on the right, you see a section called Comparable Companies Unlevered Beta. So comparable companies unlevered beta is an alternative way to estimate your beta. So in class, we covered the idea that technically speaking, in most finance textbooks, they would tell you that in order to estimate a beta for a company, what you do is you run a regression to regress the returns of that stock against the market to estimate the slope coefficient for the stock. And that is effectively your beta. Now, as we covered in class, this is a very problematic approach because the estimates that you will get for the beta are not necessarily super precise. So for example, if I go into Bloomberg, right now I'm on H&M. Now, if you are already on the company, so you've already selected your company, you can type in a page or a function called beta. Once you go into the function called beta, you can estimate the beta for any company that you wish. So I'm just waiting for it to load. It's taking a while. But effectively, you'll see something like this in front of you, and it's effectively just trying to give you the opportunity to estimate beta for any given company. So right now, I can see it's being estimated for HMB SS equity, which is H&M stock. The relative index is OMX, which is the Swedish stock index. The data that it's using is here, weekly, and again, you can use daily, weekly, or monthly returns and so on. And we also have the time period, which is technically 2 years right now. Here on the right-hand side, we see the regression output, which will give us the beta estimate. And in front of us, in smack bang in the middle, we see a chart that kind of graphically represents the returns of H&M versus the returns of the market. And then we can see a nice little line which represents the slope or the beta coefficient that we've estimated. Now, what you see here in the linear beta calculation and the results from the regression is that the beta has been estimated as 0.883 for H&M. Now, this 0.883 effectively means that it's less risky relative to the market if we assume that the market beta is 1. So it means that it's slightly less risky. What's important to remember is that this is just a point estimate. So this 0.88 is the point estimate that we have. But as with all kinds of regressions, these point estimates have a confidence interval. So to get that confidence interval, you need to look at the standard error of the beta. So in standard error of the beta, we can see is 0.097. So effectively speaking, say for example, somebody asked you, what is your point estimate for the beta? Well, you would say 0.883. If they asked you, what is the 95% confidence interval for the beta? So 95%, I'm 95% confident that the beta is between this and this number. In order to get the 95% confidence interval, you take the standard error, multiply it by 2, and then you either subtract or add it to the beta. So my low range for the, I guess my beta would be 0.88 minus 0.097 multiplied by 2. So that would be roughly 0.7 perhaps, or 0.68, 0.69. So that would be my low estimate, versus my high estimate would be 0.88 plus 0.097 multiplied by 2, again most likely around 1.08 or something like that. So effectively speaking, we have a very large range from 0.7 to almost 1.1, so it makes it a bit less, I guess, precise once we start to consider it in terms of confidence intervals. Now, the second issue that we have is, again, this beta has been estimated for H&M on weekly prices over a 2-year period relative to the Swedish stock market. Now, the problem that we have at first hand is, which stock market do we choose? So do we choose the Swedish stock market? Well, we should technically always choose the stock market that an investor would kind of benchmark themselves against. So if H&M only has Swedish investors who are only investing in Swedish stocks, so their alternative stocks are all on the Swedish stock market, well, yes, we can use the OMX index. However, most of investors these days have a global outlook, which means that using a local stock index is not necessarily the best idea. So here, for example, where it says OMX, if you click on it, you can type in MSCI, and this will give you a bunch of different options. So what I'm trying to find is the MSCI World Index, which has the code MXWO, and that's the MSCI World Index that provides us with a more global type of index. If I select that, click enter, this regression will be re-estimated for us, and we can see that the raw beta has gone down to 0.81. However, our standard error has increased to 0.159. So just by changing the stock index that we're kind of benchmarking ourselves against, the beta estimate gets, I guess, quite a strong adjustment here. Again, the next issue that we have is, do we use weekly or monthly or even daily prices? Now, we covered some of the issues in the, I guess, in the lecture, but say, for example, I choose monthly now, and again, I need to click enter for it to re-estimate. Once I've done that, and I've changed it to monthly over a 2-year period, I can see that my raw beta has gone down to 0.77 and my standard error has increased even further. So effectively speaking, what I'm trying to show you is that beta estimates are not precise. They're very volatile. They're not necessarily, I guess, something that is an exact science. So usually speaking, when we estimate the beta of a company, specifically when we try to value it, it's very rare that we actually use the beta of the company itself. Instead, what we usually do is we use something that's called comparable companies unlevered beta approach. And what this approach does is it looks at a few comparable companies, the ones that you probably would have selected in week 1, and you try to estimate the beta for these kind of companies. You then unlever them in order to adjust for their leverage, and that will give you the average unlevered beta. Once you have the unlevered beta, well, then you can apply your own capital structure and your own tax rate to get the beta estimate for your own company, and that's what we're going to be doing here. So in front of you, you can see that I've already filled in 4 companies here. I'm just done that so that it goes a bit quicker. So I'm going to show you how to do kind of complete this approach by doing it for Zara as the example company, and that way you know kind of how you would do it for all the other companies. So in order to estimate the, I guess, or estimate the unlevered beta for Zara, I need the information about its raw beta, its debt, and its equity, and its tax rate. So the first thing that we'll need is Zara's beta. Now, what I also should probably remind you is that just like when you're going to be valuing your own company for your project, I'm going to be traveling back in time. So remember when you were, I guess, completing your project, you're doing it back in the time when the announcement for the takeover was first announced. So that might be 6 months ago, a year ago, or however long ago that was. So you need to estimate all these kind of beta coefficients based on the information back then. So for Zara, I'm going to be using H&M's year and date. So the last financial year that I have available is 30th, let's see, the 2015 financial year, which has the year end of 30th of November. So if I want to get the information about the beta for Zara, I could type in the here in the top left Zara. Technically speaking, I just realized that's not necessarily gonna work perhaps, but we do see that it does actually work. So Zara is not technically called Zara on the stock market. It's called Industria de Diseño Textil, or Inditex. It's the, I guess, formal name for Zara and the corporate name. So once I've selected this one, everything in front of you will be re-estimated for you. It might just take a short amount of time. You might need to press enter. I can now see that it's been re-estimated for me. I can see that the relative index has changed. The, I guess, last price is still monthly that I had before, and so on. I can see that the raw beta here is 0.572. The first thing that I want to do is, again, I personally prefer using the MSCI index. Some other people prefer to use the S&P 500 as their benchmark index. I prefer to use the MSCI. So I choose the MSCI index as my kind of benchmark, and then I'm going to be using a 5-year period. But again, my 5-year period is going to end on the 11, which is the November 30th, 2015. And because I want to get 5 years worth of data, I'm going to put 11/30th, 2010 as my beginning date. Press enter, and it should all be re-estimated for us, and it should happen automatically. So now I can see the, I guess, the returns of Zara versus the returns of the MSCI World Index. I see the, I guess, the slope coefficient here, and the raw beta is estimated to be 0.478. Again, if you look at the standard error, it's quite big. So technically speaking, the raw beta, if we wanted to say with a 95% confidence, well, it's somewhere between 0.1 to what would it be, about 0.3 to about 0.7, 0.8 almost. So it's huge range, not necessarily that precise. So it's 0.478 is what we need. So I'm going to be entering 0.478 into the beta field. Again, it's not a precise estimate, and the idea is that even though individual estimates will not be precise, if we have number of estimates from various companies, the standard error will be decreased by averaging out the error term. Now we have the beta. Now we need the debt and the equity field as well. So debt and equity we can get from the FA function. So if you go to the FA, so financial analysis, click enter, and we need to find the market cap, or the market value of equity, which is the same as market capitalization, and the total debt of the firm back in, I guess, November 2015. Again, Zara uses a slightly different year-end date, so I can't necessarily use this financial year 2015 because it ends at the end of January. Instead, what I can do is I can try to find the quarterly statements by selecting quarters as my periodicity. So here, if I see in front of me now, I can see the quarterly information. So I want to go to the left because it's 2016, Q1 2016. I need to go to the left one more most likely, and let's see. So if I've gone to the left a bit, I can see now that quarter 3 2016 is what they call it, had the year end of October in 2015. So it's about a month away from the H&M year end for that year, so that's probably good enough. It doesn't have to be exact. I can see that the market capitalization is about 106 million. So what I'm going to be doing is right-clicking and copying that figure, pasting it into Excel, going back, and then I'm also interested in the total debt of the firm. So this is the interest-bearing debt, and I can see that they only hold 42 million. Right-click, copy, go back to Excel, paste it, and you have that figure. Next step is to then get the debt to equity ratio, which is effectively just your debt divided by equity, and that gives you the percentage term. And then finally, we need the tax rate for Zara. So the tax rate for Zara is something that we can find by Googling it. So if you look here on the right-hand side under cell B9, where it says marginal tax rate, I have a comment here where it says where you can find the tax rate. So it's a KPMG website. You can also find it if you just Google KPMG corporate tax rates around the world. So if I go to Google and I Google KPMG corporate tax rates, first hit will be corporate tax rate table. I click on there, and I effectively need to find the corporate tax rate for Zara, which is a Spanish company. So I need to go down, find Spain in the table, and find the corporate tax rate for 2015. So you can see that we have years on the columns, and we have the countries for the rows. So if I go down to Spain, I can see that Spain has a tax rate of 28% as the corporate tax rate. So I can enter 28% as the tax rate, and that's effectively it. Now again, you would have to do exactly the same process for all the other ones. What you'll probably notice is that the debt and the equity might all be in different currencies. For Zara, it's in euros. For Uniqlo, for example, it's going to be in Japanese yen. For Gap, it will be US dollars. Technically speaking, this is not an issue because all we are really concerned about is the debt to equity ratio, which means that the currency is not that important. So once we have this information, we can then go on to the left-hand side and start to fill out some of the additional information that we'll need. So for H&M, we first need to get their debt level. So in H&M's case, it's quite unique because they actually don't hold any form of debt. And you can see that in the balance sheet. So for the total debt, I go equal to, I'll go to the balance sheet, and I'll go for 2015, which is in, let's see, column H. I'd find their short-term debt, which I have in row H42, and I will add the long-term debt, which is in H50. Again, these are all zero, which means that they have zero total debt. Most other companies will have some form of debt. H&M is quite unique in the sense that it doesn't hold any debt at all. Now for market value of equity, I need the market capitalization for the firm. Now technically speaking, you can find it on Bloomberg, but I also remember that when we did our, I think it was risk analysis, we got the market value of equity because the Altman Z-score needed that as an input. So I already have it for 2015 here because I've looked it up in the previous weeks. I go to risk analysis, I9. Now I have both the total debt and the market value of equity. So if I wanted to get the total amount of capital that I have within the firm, it's 535 million. Then what I need to do is figure out what is the percentage of the capital structure. So effectively speaking, this is a very easy exercise for me, but if you had some debt, you would take, in this case, C3 and divide it by C5. Again, if you lock C5 by putting a $sign around it, you can then drag this down and get that the relative terms for each source of funding. So we know that market value of equity is responsible for 100% of their funding. Now, the next aspect that we're going to be looking at is how to estimate the cost of debt. Now, cost of debt is also slightly tricky, specifically because we're dealing with a European company, and European companies don't always have, very easily observable debt. So cost of debt is usually observed by looking at bond rates for your corporate bonds. However, H&M doesn't have corporate bonds, so that creates a slight problem. So if we, for example, don't have an observable corporate bond rate, what we can do instead is to create a synthetic kind of cost of debt by looking at a few pieces of information. So to get a synthetic cost of debt, we'll need to look at the risk-free rate, plus a premium, or what we usually call a spread. So down here below, you can see where I have a table called synthetic credit rating. And this effectively outlines that if your interest cover ratio is, for example, 8.5 or higher, then the spread is 0.6. If it's very low, or I guess as your interest cover gets lower, then the spread gets lower as well, because the interest coverage ratio is one of the ratios that we usually look at when we think about credit risk. So interest coverage ratio in H&M's case is again slightly problematic because they don't actually have any interest expenses. If we go to the income statement, we can see that H&M has, let's see, interest income. It's on row 22 and it's negative. So even though it's negative, it might be confusing, but a negative interest expense in this case means that they have interest income. So when they have interest income, it means that we can't necessarily use the interest cover ratio. But what that tells me is that that interest cover ratio is very, very good. So whenever you have interest income instead of interest expense, it automatically means that your rating is AAA, which means that the spread for H&M will be 0.6. Again, if you go down here, you can see where I said interest coverage ratio, and it's merely your EBIT divided by interest expenses. So in H&M's case, that ratio wouldn't make any sense because it would actually give you a negative. But for other firms, this will usually be a more normal range. It might be, for example, 5. And if the ratio was 5, then I'd look at interest cover from to 2. So it will be between 4.25 and 5.5. So the credit rating will be A2 or A. And these two different credit ratings are because there's two main credit rating agencies, S&P and Moody's. So again, if we had an interest cover of 5, then the spread would be 1.1. So we would take the risk-free rate for the company or the country that they operate in and add 1.1%. Now in H&M's case, again, our spread will be 0.6. So the second piece of information that we need is what is the risk-free rate. Now, the risk-free rate for your company will usually be the risk-free rate of the country that they, I guess, have their headquarters in. Now, this might have some particular exceptions in terms of this rule, but for all intents and purposes, if we're valuing a Swedish company, we usually look at the risk-free rate of a Swedish government bond. Now, getting the Swedish government bond and specifically historical rates might seem a bit tricky. There's a few different shortcuts that you can figure out in terms of which is the benchmark bond that I should be using. Technically, Bloomberg has a weighted average cost of capital function where they actually calculate everything for you. So if you type in WACC, click enter, it will actually provide you with a weighted average cost of capital calculation for you. Unfortunately, it's not necessarily that useful because they don't necessarily do a great job at it, so you would never actually use this number in practice. But you can use this information to figure out what is the appropriate risk-free rate for this particular company. So for example, here we see equity and we see the cost is 8.4. If I click on that 8.4, it will provide me with the details of how that is calculated. So here, for example, I see that the risk-free rate for H&M is 0.63. And if you hover over that, you can see that it says risk-free rate index GSGB 10-year index. And that is essentially the code that is used for a 10-year Swedish government bond. So GSGB 10-year. So I can actually type that in. So GSGB 10-year, and that will effectively show me different securities. So in this case, the first hit is the Swedish government bond 10-year note. If I click on it, I can see what that bond, I guess, looks like. So for example, I might look at a line chart to see how it's been developing over time. And again, remember that we've effectively trying to value the company back in November 2015, which means that we have to kind of go back in time if we want to find the risk-free rate as well. So here I can see the fluctuation of the risk-free rate. It's gone down from, I guess, less than, 1%. So again, this 0.6 means that it's 0.6%. So it's already very, very low right now. And it was even lower in August. So you see that's actually gone up a bit. If you look here, you can see that there's a section and a tab called Table. If I click on Table, I can see slightly more detailed table results for the, government bond and how it's developed over time. And these are all daily rates. Again, I want to get the information back from, let's see, 11/30/2015. End date can't be earlier than start date, so I have a problem here. I need to just change the start date. But effectively speaking, I'm trying to find the rate that was for the 10-year government bond back on the 30th November 2015. So again, you can basically just play around with the ranges to get that figure, and I can see it's 0.75. So this information we can actually already put into our cost of equity calculation because we'll need it there as well. So put in 0.75. So our cost of debt is effectively going to be equal to the risk-free rate plus the spread, which in our case is the lowest spread there is, which is 0.6, which means that the cost of debt for H&M is 1.35. We then need the marginal tax rate for H&M. Now the marginal tax rate for Sweden, if I go down here and I look at Sweden, well, Sweden has a marginal tax rate of 22%. So I'm going to put in 22% as my figure, and my after-tax cost of debt is merely going to be equal to the cost of debt multiplied, open up a bracket, 1 minus the tax rate. Close the bracket, and we have 1.05% as our tax rate. As our after-tax cost of debt. Now, the next section is the cost of equity. And to get the cost of equity, we're using the CAPM formula. Now, the CAPM formula says that it's equal to the risk-free rate plus the beta multiplied by a market risk premium. And if you want to be creative, you can add a size premium or a country premium and so on. But the first thing that we need is obviously the risk-free rate, which we already just looked up. We can also look up the beta, which in this case is merely our re-levered beta down here. So if you remember here, we calculated the averaged unlevered beta, which is effectively the beta if you remove all the leverage on average across the competitors and its comparable companies. We then use that to re-lever it according to the capital structure of H&M, but because they don't have any debt, it's going to be exactly the same number, which is 0.94. Now, the market risk premium, well, technically speaking, the market risk premium is not necessarily something that is completely set in stone. Personally, I use 6% when I deal with European companies. If I deal with a US company, I might use 5%. But again, you can Google these things to figure out what is the, acceptable market risk premium out there. In terms of other premiums, I'm not actually going to be using a size premium or a country risk premium because technically H&M is a huge company, so there will be no size premium. And Sweden is a very stable economy, so there will be no country risk premium either. So to calculate the cost of equity, you would take risk-free rate plus beta multiplied by the market risk premium, so it's 6.37%. And then to get the weighted average cost of capital, you would take the debt ratio, which is 0 in this case, multiplied by the after-tax cost of debt, and then add the equity ratio and multiplied by your cost of equity. Once you've done that, you get 6.37%. So again, it's not necessarily super complex what we're doing here. It's pretty simple. So effectively, all you really need to understand is the process that we're using. Now, another interesting thing that you might consider doing is to look at the sensitivity of the weighted average cost of capital and to see how would the weighted average cost of capital look like if, for example, the beta was 0.8 or 0.9 or 1, or what if the market risk premium was 5% instead of 6%? Now, to do this, we can use a function in Excel that's called data table. So in Excel, on the, top right hand side here, we can see that in the tabs, there's a tab called data, and there's a section called what if analysis. Now, what if analysis has another function called data table, which essentially allows you to do kind of sensitivity analysis very neatly. So to do this, the first thing that you need to do is you need to essentially state what is it that you wanna kind of subject to sensitivity, and you would need to put it in the top right left-hand corner here in cell G21. So in order to do that, we would put an equal sign, and we would enter and reference cell D19 here. Now it's blank and you can't see anything because I have made this cell blank so that I could hide it. But again, so if I reference cell D19, it's effectively just going to reference me my weighted average cost of capital. Now the next step that you need to do is you need to then basically tell it what you want to have as the sensitivity value. So I know that my beta is 0.94, so maybe I want to set the range of betas from 0.7, 0.8, let's see, 0.8, 0.9, 1, and 1.1. For my market risk premium, right now I have 6, so maybe I can say 4%, 5%, 6%, 7%, and 8%. Once I've done that, I essentially have all the information that I need. So what I would need to do first is I need to highlight the data table that I want to essentially populate. I have my function that I want to use, which is the data table function. So I need to go to the data tab first, what if analysis, data table, and then it will ask you to put in a row input cell, which is the market premium. So effectively, I want to put in the market premium cell, which is in cell D15 in the WACC calculation. The column input cell is our beta, and the beta is located in D14 in this case. Once I've had that, I'm essentially just going to click on OK. And it effectively calculates the WACC for me based on the sensitivity. So for example, if beta was 0.7 and the market risk premium was 4%, then the WACC would be 3.55% and so on. Now again, you can do this sort of sensitivity analysis with other types of kind of inputs. So for example, a lot of people would do it with the capital structure. So say for example, if H&M had 0 versus 10 versus 20, 30, or 40% debt to equity, what would happen to the weighted average cost of capital? But again, it all depends on your particular situation. And again, as I mentioned, I usually prefer to hide this little 6.37 that you see there by just making it a white text so that it looks slightly more neat. But that's effectively it for this week's workshop. So again, just upload your finished homework, and I'll grade it once once the due date comes around.